And I think we're back, and my guest is Dan Walkow. And of course, if you take a break, and the best conversations take place during the break.
Right.
Because Ellen Thompson's still sitting over there on the couch, and she was the author of Illusions, wherever that book went. It's disappeared on me. But in the break, she says, my brother was the powder monkey up in the north, too, so there's powder monkeys all over the place.
Lots of us old powder monkeys are.
Yeah. So where were we? We were talking.
We're just talking about the differences in the.
This is a getting to know Dan Walkow thing.
Right.
So you got to get this.
I think one of the things worth mentioning is that somebody said, would ask the question, what's different about Dan, or what? So
that's what
why are you different
why do I want to deal with Dan
than another fellow on the street? One of the things is that I have a philosophy of investing which goes along with the degrees I have and what I call whole brain investing.
Whole brain.
Whole brain.
You mean you're using your whole head?
Both sides. Both sides.
Oh, both sides.
Right
okay.
and left. The aspect of, as a fundamental analyst, as a chartered market analyst, you use. That's distracting.
This is supposed to help you learn how to use both sides of your head. And we're going to be talking to Paul Swingle in another 20 minutes or so about these things. Oh, well, there we go. I'll just turn them off. So I'm sorry, you're talking about the whole brain.
What I'm talking about is in terms of investor logic. The aspect that it was when you make investment decisions.
Are we talking about the psychology of investing?
That's right.
Okay, I like that.
That's right. And that most fundamental analysts and CFAs, because you deal in history, you're a linear thinker.
Like that.
Right. So your typical analytical approach would be to say, okay, this company grows at 10% a year. This is the earnings growth for the next 5 years. Therefore, if I take 5-year earnings out and I discount that back at some appropriate discount rate, that's the net present value of what you should pay for a stock. So that's a linear assumption going out. And most fundamental analysts act on that type of thing. They'll gather all the numbers, they'll make projections.
Well, is this why everybody can lose money at the same time?
Right.
Oh, okay.
So they'll extrapolate out. It's historical. It's important because you have to understand the facts of the situation, right?
You also know have to know who the management is.
Well, all that stuff. On the other hand, from a technician's point of view, they basically would say that everything that's known in the market, everything there is to know is already discounted in the market. It doesn't matter how much research you do, nuts and bolts research. The market, which distills everything to present-day prices.
And a whole bunch of people.
And because there's 1,000 analysts that analyze the Royal Bank's earnings or any announcement out of the Royal Bank.
Using the same parameters.
Exactly. So that's instantly into the stock. Especially with today's internet and so forth, that there's no way.
Well, what we're saying is that a share of the Bank of Montreal is worth the same amount in Montreal as it is in Vancouver or New York.
At any given point in time.
Sorry.
The world, it's instant, dissolves that instantly into current price. So you as an analytic, a research analyst, you'd analyze this and you'd come up with your value parameters and so forth and decide, is that a good value or a bad value based on that line of thinking. A technician, on the other hand, would look at this and say, how's the stock trading? Is there demand for the stock? Is there volume building for the stock? Is the stock under accumulation by accelerating volume? Is it where has it been compared to past prices given the similar financial circumstances? So you would gauge the supply and demand for the actual security, as opposed to analyzing sales numbers and earnings numbers. You'd analyze the market.
So you're analyzing the security, the volatility of the security, the demand for the security, as opposed to whatever, doesn't matter what the company is, you're talking about.
Right. So you'd use tools like, a technical analyst use tools like relative strength. How well is this stock doing relative to the market? Is it outperforming the market? Is it underperforming the market?
Well, does 3 times earnings or 12 times earnings have a factor?
That's a fundamental guy's sort of.
That's the fundamental. That's the other guy's side.
The nuts and bolts guy's side. Well, my point being is that there's value to both types of analytics. And if you go down the road simply as a fundamental analyst, you're driving down the road with one eye closed. If you are using technical analysis,
you've got a whole bunch of cars going down the road with one
right, because you're only using one half of your brain. You're only seeing out of one eye. To get a holistic picture, you have to use both sides. So Same thing from a technical point of view. If you're a pure technician and you're just looking at charts and you don't have an understanding of the fundamentals of the company, understanding what value is from that perspective, you also are going down the road with one eye open. So to get a holistic vision of value, or what to buy, when to sell it, you need both valuation techniques to come up with a composite view from two totally different approaches.
Two different. Yeah.
So that's the school I belong to, is combining, marrying these two types of analytical techniques.
And that's very rare.
And it is rare, because, well, a good example is I go to the CFA Institute conferences occasionally, and they are gray flannel suit affairs. It's
You were just off the one
right.
in Las Vegas, so I can remember it.
You're very conservative, staunch sort of analytics, as you would expect, button-down, conservative suit types. Technicians, on the other hand, are the creative people. So they're the flamboyant, artistic types, if you will.
What you looked for is a guy with a pink shirt and a tie?
You got it. So I was in Florida here at one of the conferences of the MTA, and I have never seen such a colorful group of people. And I couldn't help compare the different types of personality types as opposed to the CFAs. And I, of course, I'm one of I'm both. So you're torn. But I truly do believe that successful investing means that you incorporate both these techniques. And if you only incorporate one side of it, you have an unbalanced viewpoint. Sure, you'll be right from time to time using either technique.
Everybody has to be right.
But the issue is to try and be consistent over time, whether it's good markets or bad markets and so forth, to apply, to keep both eyes open. Gives you much better, I wouldn't say odds, but much better better investment decision-making success,
Better
I
kick
guess.
up the cap.
Yeah, it increases the odds of success. There's no magic bullet, but you're certainly better armed in terms of making investment decisions.
Well, you're less likely to be surprised.
Very true. You're less likely to be surprised, and that's half the battle, is to preserve what you have when times are tough, right? And
it's like most of us don't really care what happens as long as somebody tells us.
Yeah.
Tells us in advance if possible.
Yeah, I mean, it's a difficult challenge at the best of times. So every tool you can use to better the odds in terms of being consistently successful.
I'm starting to understand why you are a stock man primarily as opposed to a mutual fund. Because yesterday I had a lady that had, I don't know, 50 different, somebody, whoever dealt with her had sold her, she was American, of course. Yeah. Whoever had sold her something like 50 kinds of funds. Yeah. She had a fund, but they were all American funds. Yep. They were all the American family funds. Right. So she's got essentially mostly the same. There's no there's no diversity there.
It's what Peter Lynch, the famous Peter Lynch, calls diversification.
Diversification, that's a good one.
And it's multiple mutual funds. I mean, you want to think about it this way, particularly say in Canada. We'll just talk for a minute about Canada. Canada only has maybe 100 institutional grade stocks to invest in.
About 4,700.
There's 60 in the TSE index. There simply is not that many. So if you own more than one or two Canadian equity funds, essentially, just because of the nature and the size of the market, they all own the same thing. So there is no diversification when you have multiple funds in the same segment.
When you talk about 60 or 100 different stocks, perhaps, and there's 4,700 different kinds of funds, you wonder why.
There is no reason. They all own the same thing. And if you go through the top 10 holdings of most major Canadian equity funds, you'll see that they all own Royal Bank, they all own Imperial Oil, and the top 10 holdings won't vary that much from fund to fund.